Last year, Buffett in his letter had highlighted that in a 58-year, run at Berkshire, there were about a dozen investments that had really moved the needle, made an impact on, and actually led to what we recognize as Berkshire today. And so Buffett said it was approximately one good investment every 5 years on average. Both Buffett and Munger were very hardworking. Warren is still very hardworking. Charlie was still placing buy orders on a stock 6 days before he passed away. And I think even the day off or the day before he passed away, he was trying to close some grant to some institution. So he was, working till the end. But when you look at these two brilliant off the charts minds, one plus one becoming 11 when they work together. And when you consider that with them turning over as many rocks as they did and working as hard as they did, it seems strange that they could only find a good idea every 5 years. So the question is, why is that? Why is it so hard for people who are so talented? And what hope is there for the rest of us? And these dozen investments that Warren didn't name, but we can make a guess on, are companies like Coke, See's Candy, Burlington Northern, the hiring of Ajit Jain, and Cap Cities, ABC, and so on, See's Candy. So one of the questions that I think comes up is that why would they be just 12 outstanding investments and so many mediocre ones and several poor ones from these two geniuses who worked so hard and who are the best we've ever had? And I have some thoughts on that. It's an area I'm still kind of, feeling my way through, if you will. One of the things about investing is that we have to stay within our circle of competence. And when we start out young, by definition, the circle of competence is going to be pretty narrow. And it might be initially limited to a subset of products and services that you directly use. And then, of course, as you get to know the way the world works, by osmosis, that circle expands. And as it expands and as you learn more things, you're able to uncover more opportunities. But there's no real easy way or I would say prescribed way to increase that circle. And this is definitely an area where you want to be an inch wide and a mile deep rather than an inch deep and a mile wide, because then you would have no competence if you were an inch deep and a mile wide. So if we look at the investment that Berkshire made in See's Candy, See's Candy was a really quite a stretch investment for them. One of the first times that Warren paid 3 times book value for a business. The family was looking for $30 million. Berkshire offered 25 million. And they also told the family at 25 million and $1, they would walk away. And thankfully, the family accepted their offer and Seas became part of Berkshire Hathaway. Both Warren and Charlie have said that they were at that time barely smart enough to buy Seas. And it was actually quite dumb not to have been willing to pay up for a business like See's Candy. And they didn't realize how good a business it was till they had a few years of experience observing how the business did. And they got a very big education on brands and pricing power over a few years. So Warren famously delegates, it's delegation to the point of abdication, as Munger says, which sees the only area that he got involved in was on January 1st, he raised prices on the candy every year. And so he basically had them send them the price list and he would scratch out all the old prices and put in all the new prices and tell them, okay, this is the new prices for the year. And those prices were being raised at significantly above the rate of inflation. And what they observed was that the pounds of candy sold grew on average from the time they bought Seeds till about today it's grown at approximately 1.5 or 2% a year, which they actually found quite stunning because they were, putting through 10, 15% price increases when inflation might be 3, 4, 5% or something. So it's significantly above inflation. And the customers didn't protest. And it surprised them. It surprised them how much they were able to raise prices. And actually, if we look at Seas is very heavily a California company. If we look at California GDP growth in that period from, let's say, the mid 70s to, let's call it 2000. If you look at that 25-year period, California GDP probably grew at a faster rate than US GDP. And it might have grown 4 to 5% a year, at least in the 70s and 80s. So Seas was growing below California GDP in terms of volume growth. It was growing ahead of California GDP from a revenue point of view. And part of that might have been the very heavy price increases they were putting through, but also they were dealing in box chocolate with dedicated retail outlets, which is a very unusual formula and a formula they have found very difficult to replicate in other locations. They've repeatedly tried to expand Seas to other locations, and most of the time they have failed. So even today, it is heavily a California story. But they got a big education in brands from owning Seas. And the investment in Coca-Cola, which came about 13 years after the Seas investment in the late 80s, would not have happened if the Seas investment hadn't happened. So in 1988, Berkshire Hathaway put one quarter of its entire book value into Coca-Cola. It was a huge bet that they made on Coke. And they were very confident about that bet. I think that the time it took to learn to make that bet might easily have been 5 or 10 years of ownership of Seas, at least 5 years. So you would have gone into the 80s. And then to compare and contrast a Coke to a Seas is another exercise that would have taken them some time. These are not quantitative issues, these are very qualitative issues you get into. And even though we think Coke is a product we are very familiar with, and it appears to be a relatively straightforward, simple business, it's actually a very complicated business. Even today, so if you look at Coca-Cola today, it was founded in 1886. It's 138 years old. Even after 138 years, it is an emerging story and with emerging market growth kind of numbers in a number of countries. And even in some countries, if some areas have matured, there are other areas which are very embryonic. So even after 138 years, Coke is not a mature company. It's still growing and it's still expanding. And it's actually more than 100 brands. And the flagship brand still makes up probably 70, 80% of the pie, even after, 138 years of all these different acquisitions and different brands and different things they brought into the tent, the core product remains a very central part. So understanding Coke to the point that a insurance company would put a quarter of his book value into it and consider it a total no-brainer bet is not something that would happen in a month or 3 months or something. So basically, the circle of competence they had went through a very significant shift because of the Seas acquisition. And of course, Coke and Seas are very different in the sense that Coke travels really well. Seas doesn't travel. And Buffett has said that one of the advantages Coke has is that it doesn't have an aftertaste. We cannot consume endless amounts of chocolate. After we consume some chocolate, our propensity to consume more chocolate goes down. But with Coke and other products they have, that propensity to have it on a very regular basis doesn't go down. And so you get to some remarkable statistics in terms of per capita 8 ounce servings per year in different countries and so on. If you look at a business like Burlington Northern, the railroad. So for the longest time, Buffett and Munger were very negative on railroads, rightfully so. It's a very regulated industry. It's very high capital investments. You have to take loads of toxic chemicals, which could cause you a lot of problem if there's a, train derailment or something. You can't refuse shipments of chlorine or something because you're concerned about that and you don't get paid extra for it. So basically, because you're a common carrier, you have to transport those things at published prices of other commodities and so on. But again, they realized after studying it for a while that there'd been a number of changes, and they were actually late to the party. So, for example, the change from single decker to double decker trains, where they double stacked the containers, and redoing the bridges so that the taller trains could pass through, was a project that took many years to get done, but it gave the rails a huge advantage. And similarly, there were a lot of advances that came about in terms of efficiency of labor. And, when diesel prices or gasoline prices start going up, then rails become a lot more competitive versus trucks. So again, it took them a few years to understand that there had been a big change in railroads. And they acquired Burlington Northern. They first bought the stock, but they acquired the entire business in late 2009. And again, that was another example of something that took several years. So I think that when we look at investing, what we are looking for is, so when they finally figured out Burlington Northern, they had an edge which the rest of the world didn't have. And when they figured out Coke, they also had an edge that the rest of the world didn't have. Coke was at a single digit trailing multiple. It had two very gifted managers who were running the place. They had started to transform the way they were allocating capital. They were shedding all the non-core businesses. Coke had bought movie studios and shrimp farms in Thailand and all kinds of things under the sun, which were totally useless, unrelated, very poor businesses. And they were shedding all of those. And it became a buyback machine. And so all those different kind of factors coming together became what Charlie would call a Lulapalooza. And, 1 + 1 becomes 11. And it led them to understand that there was a huge differential between where the company was going to be, what it was going to generate in terms of growth and cash flows in the future versus the past. And the same with railroads, right? I mean, they saw a huge delta. Similarly, with the utility business under that leadership with Greg Abel and Dave Sokol, or like Ajit Jain coming on the scene, running insurance. So each of these things was a big aha moment. And in an investing lifetime, if we end up with two or three of these big aha moments, we're doing pretty well. And so investing is a game where there can be long periods where there's nothing interesting. And then suddenly something shows up and suddenly you have an edge. You understand things better than the rest of the world does, or you've done a drill down which has helped you understand it better than the world does. And then, as Charlie would say, you go all in. And so those opportunities come few and far between. Usually they don't last for that long. And so it's a game of extreme patience with extreme decisiveness. So that combination of extreme patience with extreme decisiveness may not come naturally to a lot of humans. I'll stop there. Longer preamble than I wanted, but I just think that it's an area where when I look back at my own investing journey, I can see that there were these moments, not that many, in the last almost 30 years. And it was obvious that you had to step up to the bat and